Ladies and gentlemen, put down your charts and listen very carefully. Everything you thought you knew about the financial markets, the entire narrative of the people versus the powerful banks, has just been proven wrong. For 15 years, we have told ourselves a very specific story. We told ourselves that the big bullion banks, led by JP Morgan, were the villains of the silver market. We believed they were trapped in a massive naked short position. We believed that when the price of silver finally broke free, these institutions would be destroyed. We thought we were the ones squeezing them. We thought we were watching their funeral. We were wrong. We were not squeezing them. They were waiting for us. Recent data surfacing from deep analysis of exchange warehouse receipts and custodial vaults has just rewritten the history of the global economy. It turns out that JP Morgan did not get caught in this recent price explosion. They engineered it. While the world was distracted by the stock market and digital currencies, JP Morgan was quietly closing their infamous short positions. They did not just exit the trade, they flipped the board. They are no longer short, they are net long. And they are not just a little bit long. JP Morgan is currently sitting on a physical stockpile of approximately 750 million ounces of silver. Let that number sink into your mind. 750 million ounces. This is the largest private hoard of physical silver in human history. It is more than the Hunt brothers held during the famous silver corner of 1980. It is more than the total holdings of the major silver exchange-traded funds. In fact, it represents roughly 62.5% of the entire annual global mining supply. Think about the implications of this. For the last decade, while retail investors were screaming about price manipulation, JP Morgan was methodically backing the truck up to the mine. Every time they smashed the price down with paper contracts, they were not doing it to save the dollar or help the Federal Reserve. They were doing it to buy physical metal at a massive discount. They used their paper leverage to suppress the price so they could accumulate the real asset for pennies on the dollar. Now that accumulation phase is over. They have the metal. And if you own 750 million ounces of an asset, you do not want the price to go down. You want it to go to the moon. This means that the biggest silver bull in the world is not a group of internet traders or a billionaire tech CEO. It is the very bank we thought we were fighting. JP Morgan has effectively cornered the global silver market. They have executed the longest and most profitable bait and switch in financial history. They convinced the world they were bearish while they became the most bullish entity on the planet. This explains why they have stopped fighting the rally. They are no longer losing money as silver rises. They are making a fortune. Every $1 increase in the price of silver adds $750 million to their balance sheet. The trap has been set, the doors are locked, and the real game is just beginning. To understand how JP Morgan managed to pull off this massive accumulation, we have to go back to the scene of the crime. This was not a plan they hatched last week over a drink. This is a master strategy that was set in motion during the darkest days of the 2008 financial crisis. Specifically, we have to look at the month of March in 2008 when the global financial system was on the verge of total collapse. At the center of the blast radius was a legendary investment bank called Bear Stearns. Most of the public remembers Bear Stearns as the first major domino to fall during the subprime mortgage crisis. You might remember the headlines and the panic as their stock price crashed from over $100 to just $2 a share. But the history books usually leave out the most critical detail. Bear Stearns did not just fail because of bad mortgages. They failed because they were the largest naked short seller of silver in the world. They had built a massive concentrated short position on the futures market that was so large it had become a noose around their neck. When the price of silver started to rally in early 2008, Bear Stearns was getting margin called into oblivion. They were bleeding cash at a rate that threatened to pull down the entire banking sector. To prevent a systemic meltdown, the Federal Reserve orchestrated a shotgun wedding. They forced JP Morgan to acquire Bear Stearns for a fraction of its former value. When the team from JP Morgan walked into the Bear Stearns offices to inspect the books, they found a toxic waste dump of short positions. At the time, every analyst thought this was a burden. They thought JP Morgan was doing a favor for the government by swallowing this poison pill. But the chief executive officer of JP Morgan, Jamie Dimon, does not do favors. He does deals. He looked at that massive short position of nearly 200 million ounces of paper silver, and he saw something that no one else saw. He realized that holding the largest short position in the market gave him absolute control over the price. If you control the short side, you control the ceiling. You decide how high the price is allowed to go. You become the governor of the global engine. Instead of closing the Bear Stearns shorts and taking a loss, JP Morgan adopted them. They integrated that short position into their own trading desk and used it as a weapon for the next 15 years. Whenever physical demand started to rise, or whenever retail investors got too excited, JP Morgan would unleash the Bear Stearns short weapon to smash the paper price down. While the world watched the paper price crash, JP Morgan was using the confusion to build a private vault system that would eventually hold nearly 1 billion ounces. They effectively turned a liability into a fortress. They realized that if they could suppress the price for a decade, they could buy up all the physical metal in the world with the very profits they made from the short positions. It was the perfect self-funding crime. The Bear Stearns legacy was not a curse for JP Morgan. It was the foundation of their ultimate victory. To execute a 15-year accumulation plan, you do not just need capital. You need a deep understanding of human psychology. JP Morgan understood that to buy all the silver in the world, they first had to make the world hate silver. They had to make it look like a dead asset, a relic of the past that would never provide a return. This is the art of psychological suppression. For over a decade, they used the massive paper leverage inherited from Bear Stearns to create a cycle of hope and despair that broke the will of even the most dedicated investors. The mechanics were simple but brutal. Whenever silver showed signs of a breakout, usually around 2 in the morning or during thin trading hours in the Asian markets, JP Morgan's trading desk would dump thousands of paper contracts onto the exchange. This was not normal selling. This was spoofing. They would flood the system with sell orders they had no intention of fulfilling, just to trigger the stop-loss orders of hedge funds and retail traders. In a matter of minutes, the price would drop $2 or $3 for no fundamental reason. To the average investor, this looked like a failure of the asset. The financial media would immediately run stories about how silver was a terrible investment and how industrial demand was falling. But while the retail public was panicking and selling their physical coins in bars, JP Morgan was standing in the shadows as the buyer of last resort. They used the fake paper price to buy the real physical metal. They were effectively subsidizing their own accumulation by stealing the confidence of the masses. Think about the frustration of the last 10 years. Do you remember the tamps? Do you remember the days when every other commodity was rising while silver stayed flat or went down? That was not the free market at work. That was a sophisticated algorithm designed to bore you to death. JP Morgan knew that if they kept the price low enough for long enough, the mining companies would stop exploring for new deposits. They knew that if the price stayed stagnant, the public would stop looking at silver as a hedge against inflation. By keeping the price artificially low, JP Morgan ensured that they were the only ones with the deep pockets and the long-term vision to stay in the game. They built a massive private vault in London and expanded their presence in the New York vaults. They even became the custodian for the largest silver exchange traded fund, known as SLV. This gave them an inside look at exactly how much silver retail investors held. They could see the cards of everyone at the table while keeping their own hand hidden. They treated the global silver market like a distressed asset. They artificially created the distress, and then they bought the dip that they themselves had engineered. For 15 years, the victims of this scheme, the miners and the retail stackers, unwittingly funded the very vault that would eventually be used to squeeze them. The suppression phase was not just about price, it was about ownership, and by the end of 2024, JP Morgan owned it all. We often throw around numbers like millions and billions in the world of finance, and we become desensitized to their actual scale. But in the physical world of commodities, geology has hard limits. When we say JP Morgan is sitting on 750 million ounces of silver, we are not talking about a simple trading position. We are talking about a hostile takeover of the periodic table. To understand why this number is a death sentence for anyone shorting silver, we have to compare it to the reality of global production. Every single silver mine on planet Earth, from the massive primary mines in Mexico to the copper and lead byproduct operations in Peru and Australia, working 24 hours a day, produces roughly 830 million ounces of silver per year. That is the hard physical ceiling. You cannot print silver out of thin air like a central bank prints currency. Now, look at the math again. JP Morgan's hoard of 750 million ounces represents approximately 90% of the entire annual mining output of the human race. Imagine if one private company bought 90% of all the oil produced in the world in a single year. Imagine if one entity owned 90% of the global wheat harvest. We would call that a monopoly. We would call it a national security threat. But because JP Morgan did this quietly, ounce by ounce, over 15 years, the world stayed asleep. They have effectively privatized the global supply of a metal that is essential for modern life. Let us compare this hoard to the official exchanges. The COMEX is supposed to be the price-setting mechanism for the world. Traders look at the registered inventory of the COMEX to judge how much silver is available for delivery. Right now, that inventory is hovering around 30 million ounces. JP Morgan holds 750 million ounces in their private vaults. This means JP Morgan has 25 times more silver than the entire public exchange system. The COMEX is no longer the real market. It is a sideshow. The real silver market is whatever JP Morgan says it is behind closed doors. By accumulating this much metal, JP Morgan has removed the float. In the stock market, when the float dries up, the price goes parabolic. In the silver market, the float is the physical metal available for sale at current prices. By taking 750 million ounces off the table, JP Morgan has created a vacuum. This is not just a large position, it is a nuclear option. JP Morgan now has the power to withhold supply. If they refuse to sell for just 1 month, the industrial supply chain of the Western world would collapse. Solar panel factories would go dark. Electronics manufacturers would stop production. They have moved from market manipulation to market domination. They suppressed the price for 15 years so they could own the metal. And now they own the metal so they can squeeze the world. This fortress of silver ensures that JP Morgan is no longer a player in the game. They are the house, and the house is about to collect. Why now? Why did JP Morgan wait until this specific window to finally flip their position and let the price run toward $80? To find the answer, we must look at the calendar. Specifically, we must look at the date of January 1st, 2026. Banks of this magnitude do not trade based on simple chart patterns. They trade based on information asymmetry. They have intelligence networks that rival the most powerful government agencies, and those networks have been signaling a massive shift in the East for months. The announcement that the Chinese government is implementing a strict export license system for silver is the final piece of the puzzle. This is not just a bureaucratic rule change. It is a strategic blockade. China is the largest refiner of silver in the world. For decades, the Western world has relied on a steady flow of cheap silver from the East to fill the massive gap between what we mine and what we consume. We have a structural deficit of nearly 250 million ounces a year, and China has been the primary source for that missing metal. On January 1st, 2026, that door slams shut. The new regulations require Chinese exporters to meet massive production and credit thresholds that will eliminate small and medium-sized suppliers. More importantly, it gives the Chinese state absolute control over who gets the metal and at what price. Beijing has realized that silver is a strategic asset for their dominance in solar energy and electric vehicles. They have decided to keep the silver for themselves and starve the Western factories. JP Morgan knew this was coming. Their analysts in Shanghai likely saw the draft legislation months before the public did. This is why JP Morgan spent the last half of 2025 aggressively draining the exchanges and filling their own vaults. They were in a race against time. They had to secure their 750 million ounces before the Chinese blockade went into effect. They knew that once the flow from the East stopped, the price of silver would no longer be set by paper contracts. It would be set by desperation. This is a classic pincer movement. On one side, you have the Chinese government restricting supply to protect their national interests. On the other side, you have JP Morgan, the largest bank in the United States, hoarding the only remaining large-scale stockpile in the West. The global industrial sector is caught right in the middle. When the calendar turns to 2026, companies like Tesla and Samsung will find themselves in a world where there is physically not enough silver to go around. They will look to the east and see a red wall. They will look to the west and see the locked doors of JP Morgan's vault. The trap has been set perfectly. JP Morgan didn't just corner the market, they positioned themselves to be the sole provider of a metal that the world cannot live without. They have turned a commodity into a geopolitical weapon, and they are the only ones with their finger on the trigger. We are now entering the kill zone. We have identified the predator, which is JP Morgan with their 750 million ounce stockpile. We have identified the terrain, which is the supply shock engineered by the Chinese export ban. Now we must look at the prey. The entities standing directly in the crosshairs of this 15-year trap are not the retail silver stackers. They are the entire Western technology and green energy sectors. We are witnessing the setup for the greatest wealth transfer in history, moving from the people who write code to the people who own atoms. For the last 20 years, the technology boom was built on a very specific and arrogant assumption. The assumption was that hardware is cheap and software is expensive. Trillion-dollar empires like Apple, Tesla, and Samsung were built on the belief that raw materials would always be infinite and disposable. They treated the periodic table like a grocery store that never closes and never raises its prices. They built just-in-time supply chains and kept zero inventory of physical commodities. They laughed at the idea of stockpiling because they believed they could always buy what they needed on the paper market for the same low price. This arrogance was subsidized by JP Morgan. By keeping the silver price artificially suppressed for over a decade, the banking system was effectively providing a massive discount to Silicon Valley. Every iPhone, every laptop, and every Tesla battery ever built was made possible by the manipulation that crushed the mining industry. But traps do not stay open forever. You let the animal get comfortable. You let it eat the bait. You wait until they have built billions of dollars of infrastructure that cannot function without the resource. And then you snap the trap shut. That snap happened when China and JP Morgan moved in tandem to lock up the global supply. Suddenly, the just-in-time model is dead. It has been replaced by the not-at-any-price model. When Elon Musk tweeted that the situation was not good, he was not looking at a stock chart. He was looking at his production schedule for the next 24 months. He realized that Tesla needs tens of millions of ounces of silver to hit its targets, but the silver is gone. This is where the wealth transfer occurs. When Elon Musk or Tim Cook calls JP Morgan to secure the silver they need to keep their factories running, Jamie Dimon will not sell it to them at the spot price of $79. He will look at his 750 million ounces and say the price is whatever I say it is. If these tech giants want to survive, they will have to write checks for billions of dollars to the very bank that suppressed the market. The wealth will flow from the balance sheets of Silicon Valley directly into the vaults of Wall Street. The tech lords are about to discover that software is worthless if you do not have the hardware, and the hardware is now owned by the bank. The predator has cornered the prey, and the price of escape will be a pound of flesh. The world is currently obsessed with the transition to green energy. Governments across the globe have passed laws mandating net zero emissions by 2030 or 2050. They have promised a future powered by solar panels on every roof and electric vehicles in every garage. But there is a massive, uncomfortable truth that these politicians and environmentalists have ignored. The green revolution is not built on thin air or good intentions. It is built on silver. Silver is the most conductive element on the periodic table. It is an essential component in every solar cell and every electric vehicle circuit. As the world attempts to move away from fossil fuels, the demand for silver is projected to explode. The solar industry alone is expected to consume more than 20% of the total global silver supply within the next few years. But here is the problem. All the economic models used by governments to justify the green transition were based on silver being cheap. They did the math when silver was $20 an ounce. They assumed the inputs would stay stable forever because they believed the banking system would keep the lid on the price. This was the ultimate mirage. By suppressing the price of silver for 15 years, JP Morgan allowed the green energy sector to grow into a giant based on a false cost structure. Now that the bank has flipped long and the supply is being restricted, that cost structure is about to shatter. When the price of silver doubles or triples, the cost of manufacturing a solar panel or an electric vehicle battery does not just go up slightly. It creates a domino effect that makes these technologies economically unviable for the average person. This puts world governments in a terrifying position. They have committed their entire political reputation to the green transition. If they cannot get the silver, the transition fails. If the price of silver goes to $100 or $200, the subsidies required to keep the green revolution alive will bankrupt national treasuries. And who holds the only stockpile large enough to save these government mandates? JP Morgan. JP. We are moving into a period where silver is no longer just a metal. It is a strategic political asset. JP Morgan's 750 million ounces represent the keys to the green energy kingdom. If a government needs to hit its climate targets, they will have to go to the bank and pay the toll. Taxpayer money will flow directly into the vaults of the House of Morgan to pay for the metal that was suppressed for over a decade. The green energy mirage is fading, and underneath it, we find a reality where the transition to a cleaner future is entirely dependent on the greed and timing of a single financial institution. The world wanted a green revolution, but they forgot to check who owned the fuel. We have to look at JP Morgan's 750 million ounce hoard and ask ourselves the ultimate question. Why would a bank that literally owns the Federal Reserve as a major shareholder bet so heavily on a metal that has historically been the enemy of paper money? Banks usually hate gold and silver because you cannot print them, and their existence exposes the devaluation of the paper currency that gives banks their power. If the king of fiat currency, JP Morgan, is suddenly hoarding the king of hard assets, what does that tell you about their confidence in their own product? It tells you that they know the game is over. It tells you that this massive accumulation of silver is not just a trade, it is a lifeboat. JP Morgan is not just betting on silver. They are effectively shorting the Federal Reserve and the United States dollar. They have realized that the purchasing power of the dollar is about to fall off a cliff, and they want to own the one thing that the government cannot dilute. Think about the context of December 2025. The United States national debt has spiraled past $38 trillion. The interest payments alone on that debt are now costing taxpayers nearly $1 trillion a year. The Federal Reserve is trapped. If they raise interest rates to fight inflation, the government goes bankrupt under the weight of the interest payments. If they lower rates to save the economy, the dollar loses its value even faster. There is no mathematical way out that does not involve massive currency devaluation. Jamie Dimon, the chief executive officer of JP Morgan, recently changed his long-standing skeptical tone regarding precious metals. He admitted that in the current environment, it is semi-rational to hold gold and silver. This is code for the system is broken. JP Morgan has used their fake paper dollars, the ones they get for free through the central banking system, to buy up the world's supply of physical silver while it was still cheap. They have effectively exchanged a dying paper liability for a permanent physical asset. This changes the $100 price target from a simple supply and demand goal to a monetary reset target. If the dollar devalues by 30% in real terms over the next year, silver does not just rise because people want it for solar panels. It rises because the dollar is becoming worthless. JP Morgan is positioned to profit from every step of this collapse. They are the arsonists who bought fire insurance right before lighting the match. Their silver fortress is the insurance policy that ensures they will remain the most powerful institution on earth long after the dollar has been sacrificed to the debt gods. They are not just protecting their wealth. They are positioning themselves to rule the new order that comes after the reset. Is a $300 silver price a fantasy, or is it an inevitable mathematical conclusion? To answer this, we must look at the two most powerful indicators in the precious metals market, the gold price and the gold to silver ratio. As we sit here in late December 2025, gold has shattered every historical record, trading at an incredible $4,500 per ounce. This massive surge has been fueled by global central banks, led by Poland, India, and China, who have added hundreds of tons to their reserves this year alone. Historically, silver and gold move together like a shadow in its object. However, silver is much more volatile. When gold moves, silver eventually follows with more velocity. For most of the modern era, the gold-to-silver ratio has hovered between 60-1 and 80-1. But we must remember that for thousands of years, and even under the United States Coinage Act of 1792, the ratio was fixed at 15-1. This was not an arbitrary number. It reflected the actual physical abundance of the two metals in the Earth's crust. If we apply that historical 15-1 ratio to today's gold price of $4,500, the math is staggering. It places the fair value of silver at exactly $300 per ounce. Even if we use a more conservative modern ratio of 30 to 1, we are still looking at $150. Currently, with silver trading near $80, the ratio stands around 56 to 1. This tells us that despite the recent rally, silver is still significantly undervalued compared to its yellow brother. But the price target is not just about ratios. It is about a structural deficit that has now entered its fifth consecutive year. According to the Silver Institute, the cumulative deficit over the last 5 years has reached nearly 800 million ounces, which is almost an entire year of global mine production. The world is consuming more silver than it can pull out of the ground, and the above-ground stockpiles are vanishing. In fact, reports from the London bullion market suggest that free-floating inventories have reached such low levels that lease rates for silver have spiked to record highs. JP Morgan knows this math better than anyone. They did not spend 15 years accumulating 750 million ounces to sell for a small profit at $80. They are waiting for the revaluation. They want to see silver repriced to a level that reflects its true scarcity and its industrial necessity. When the industrial panic bid from companies like Tesla and Samsung collides with the monetary flight to safety, the liquidity will dry up instantly. In a market where there are no sellers and everyone is a buyer, the price does not move in inches. It moves in miles. $300 is not just a target. It is the price that the market will eventually demand to balance the scales between 15 years of manipulation and the cold reality of geology. We are now standing at the threshold of a new financial era. The trap has snapped shut on the industrial world, the Chinese export ban is only days away, and JP Morgan has moved from being the market's biggest enemy to its most powerful driver. But the most important question remains: what do you do now? How do you navigate the volatility that is about to hit the market on January 2nd when the institutional traders return to their desks? First, you must understand the psychology of the final shakeout. Even though JP Morgan is net long 750 million ounces, they still want to buy your ounces as cheaply as possible. Do not be surprised if you see a sudden violent price smash in the first week of January. They may use paper contracts to push the price from $80 down to $72 or even $70. This is a classic bear trap designed to trigger the stop losses of weak hands and clear the leverage before the real move to triple digits. If you see a red candle next week, do not panic. Recognize it as the last opportunity to acquire physical metal before the industrial panic bid begins. Second, watch the physical premiums. In a manipulated market, the paper price on your screen often lies, but the physical premium always tells the truth. If the spot price drops, but the cost of a 1-ounce silver eagle stays high or increases, it is a clear signal that the paper market has broken and physical scarcity is taking over. Keep a close eye on the Shanghai premium. If the price in China remains $10 or $15 higher than in New York, it acts as a giant magnet that will eventually rip the global price higher regardless of what the paper traders do. Third, define your exit strategy with extreme discipline. Many people ask if they should sell at $100 or $150. My answer is simple. Sell for what? Why would you trade a physical asset that the world's most powerful bank and the world's largest manufacturing sector are fighting over for a paper currency that is being devalued by the trillions? You do not sell silver for dollars. You exchange silver for other real assets. You use it to buy land, to acquire cash-flowing businesses, or to eliminate your debt and become truly free. The era of paper derivatives and just-in-time manufacturing died this year. We have entered the era of the real. In this new world, those who hold the physical atoms, the silver, the gold, the oil, and the land, will make the rules. Those who hold the digital bits and the paper promises will be the ones paying the tribute. You have survived the years of boredom and manipulation. You held your position when everyone else called silver a dead asset. Now, you are sitting at the table with the giants. You and JP Morgan are on the same side of the trade for the first time in history. Hold the line. Trust the math of the geology and the reality of the deficit. The triple-digit price is not a matter of if, but when. The vault doors are closed, the supply is gone, and the greatest wealth transfer in human history has just begun. I am John A.G. from Currency Archive. Remember to like, subscribe, and share this report with those who need to see the truth. Stay strong, stay physical, and I will see you on the other side of the reset.